There's something going on in the U.S. oil market right now, and it could be pointing to an even more severe recession than some of the biggest doomers and gloomers on YouTube have been pointing to. Now, normally I maintain what some might refer to as a healthy dose of skepticism when it comes to government data points. Everything they tell you is bullshit. And so for the sake of this analysis, I'm going to use a mix of both government and private sector data points, and you're going to see that they're both in agreement here. United States oil inventories are climbing even though we have just stopped dumping the Strategic Petroleum Reserve, which you would think would send supplies even lower, and it's all pointing to a drastic reduction in U.S. manufacturing activity, which tells me the recession that's coming, or the recession we've been in for a while now, is about to get a whole heck of a lot worse. With that, we are going to shrink my big melon of a head, and let's get into some of this data. First of all, what we're looking at here is crude oil prices. I just want to give you guys an idea. This is going all the way back to the beginning of 2022. Now, up here at the peak, this was the dumping of the Strategic Petroleum Reserve. We dumped over 180 million barrels of crude oil from the SPR last year into the open market. That drastically suppressed prices. Now, what we've seen here since the start of this year is we've actually seen a slight increase in oil prices, although that came just after a big sell-off on the first 2 trading days of the year. And so really where we're at right now, oil prices, as of the making of this video, are pretty much within a couple of cents of where they started the year. So whatever is going on in oil markets right now, it hasn't really moved the price. Now, the data points that have been catching my attention lately have been oil inventory stocks. Now, this data is put out by the Energy Information Administration. These are government numbers. But what we're looking at here is weekly numbers of inventory counts. And if you look for these first 3 complete weeks of 2023, we've seen inventory builds for 3 weeks in a row. Now, this latest data point from today is only about a 500,000 barrel increase in inventory, so it's not a huge data point. But if you take the average of the last 3 weeks, the EIA numbers are averaging a 9.3 million barrel per week increase in oil inventories in the U.S. Now, again, we just stopped dumping the Strategic Petroleum Reserve, and we were dumping about 5 million barrels a week. So we're seeing this average of 9.3 million barrels per week of inventory build, even though the supply hitting the market is down by 5 million a week. So the actual dislocation with supply and demand here is even bigger than this chart is showing. Now, my initial thought was these are government numbers that could be wrong, so I went and I looked at the API oil stocks change. Now, this is put out by the American Petroleum Institute. This is a private sector trade organization made up of U.S. oil companies. These are not government numbers, and we see something similar here. Look at these first 3 weeks of inventory data for 2023. Now, if you take the average of the first 3 weeks of 2023 in the API numbers, you're getting an average build of 8.6 million barrels per week. A little bit below the 9.3 million that the EIA is showing, but still they're in the ballpark. We're talking about rounding errors here, folks. These numbers are in agreement. So if you take the average of the last 3 weeks of inventory builds in crude oil in the U.S., you can take the Energy Information Administration, the government's number, and you average it with the American Petroleum Institute, the private sector number, you come up with an average of a 9 million barrel per week inventory build in the U.S. for the first 3 weeks of 2023. Now, the United States uses on average about 20 million barrels of oil a day, or 140 million barrels a week. So an average weekly build of 9 million barrels per week, that shows a significant reduction of oil consumption in the United States so far in 2023. But you have to also factor in December, we finally stopped the dumping of the Strategic Petroleum Reserve. We were dumping almost 5 million barrels a week from the SPR into the open market. So while we've seen an inventory build of 9 million barrels, you can add 5 million more to that to account for the lost supply from the SPR dumping that just ended in December. Now we're looking at a net change of about 14 million barrels per week. That's a 10% reduction in oil consumption according to these 3 data points. Now I want to caution you here that 3 data points, it doesn't necessarily make a trend. These numbers are known to fluctuate up and down, and next week we could get a massive negative number that offsets a lot of this analysis. But 3 consecutive weeks of inventory builds, that's something unusual. Now, I want to put this in context. From 2007 to 2010, with the global financial crisis, the United States saw about a 3.5% reduction in oil demand. So if my math here is anywhere near accurate, we're seeing a really significant reduction in oil demand, which tells me this recession is going to be every bit as nasty as 2008, maybe a whole lot nastier. Now, I also just want to mention that I looked into oil imports to see if that might have been making any changes. Maybe we suddenly started importing more oil in January, and that's why we're seeing these inventory builds. Well, according to the EIA, that's not really the case. We did see a big bump in imports that first week in January, but then we saw 2 consecutive negative numbers. And so the average of these 3 data points shows that U.S. crude oil imports actually declined by 100,000 barrels per week during the same data point. So this big inventory build we're seeing, it's not due to a sudden surge in imports. Now, I've been really scratching my head on these inventory numbers until I came across this tweet from Giovanni Stanovo. Now, this came out just today after the latest EIA data point was released, and I want to zero in on some of these data points down here where he's carving out some of the specific fuel types. Now, he's talking about gasoline and jet fuel and distillate and residual fuel oil, but the big one I want to zero in on here is look at this negative 466,000 barrel per day number for propane and propylene. Now, I had to do a little bit of math here to try to figure out how much of this number was propane and how much of it was propylene. And I had to backfit the data a little bit here using some of the numbers for fuel oil. Now, fuel oil would fall under the distillate number, which is negative 146,000 barrels per day. Now, about 60% of all distillate is used for diesel fuel, which leaves about 40% is used for home heating oil. So this 146,000 barrel per day number turns into about 60 million barrels per day of reduced demand for home heating oil. So we can use that 60 million barrels per day in lost demand for home heating oil and kind of extrapolate how much of this number is due to propane, because a lot of homes use propane for home heating. Also, it's a little bit less than home heating oil numbers. So for the sake of argument, we're going to be conservative here, and we're going to assume that about 400 million barrels per day of this number is due to lost demand for propylene. Now, that's important because one word, plastics. And I have been waiting to use that quote since day one of starting this channel. Today, I finally get to use it. 75% of propylene manufactured in the United States is used for making plastics. And well, plastic is in everything. Plastic is in packaging material. Plastic is in consumer products. It's everywhere. So when I see that the largest contributor to the reduction of oil demand in the United States is not coming from people driving less, it's not from gasoline, it's actually coming from the manufacture of plastic, that tells me the problem is economy-wide. This is not any one sector or any one thing. Plastic is used everywhere. And so that made me want to dig into the manufacturing numbers, something I've covered on this channel recently. We've had some really lousy manufacturing numbers in the United States over the last few weeks. And when I did that, I saw exactly what Giovanni Stanovo's tweet was telling me, that United States manufacturing is slowing at an alarming rate. Let's look at this first number, United States manufacturing production. This was produced by the Federal Reserve last week. U.S. manufacturing production decreased by 0.5% year on year in December of 2022, and that was the first decline since January of 2021. So that's not a huge or alarming trend, right? 0.5% decline in manufacturing in December. All right, that's not the end of the world, but it is the first decline in a long time. So let's check out the manufacturing PMI, or Purchasing Managers Index. Now, this is produced by S&P Global. Again, this is private sector data. This is not a government data point. Well, the latest data from S&P Global came in at 46.8 for January. Anything below 50 shows manufacturing in the U.S. is contracting, and it was at 46.8 in January of 2023. Now, that was up slightly from the 46.2 in December, but reading from this report here, this reading continued to point to another contraction in factory activity, which was the second fastest since May of 2020, as manufacturing demand conditions remain subdued. Output contracted following another sharp drop in order inflows, with firms highlighting the impact greater costs were having on client demand. The rate of decline of new business was the second fastest in over 2.5 years, and firms cut their workforce numbers for the first time since July of 2020. And here you can see, going all the way back to the middle of last year, the U.S. manufacturing PMI has been in decline. It's been below 50, i.e. negative territory, for 3 consecutive months. That means U.S. manufacturing is contracting faster and faster. And when I zoom out on this chart, you get an idea of just how bad this is. Now, this data only goes back to about 2011, and you have to ignore this data point here. That was at the height of the unfortunate health scenario in 2020 that I'm not allowed to talk about. But look here, since the end of 2021, really since the end of the easy money, folks, look at how the PMI for manufacturing has just continued to decline. And it's been in negative territory 3 consecutive months now. And something tells me this number is going to stay negative for a while, because we've also gotten a couple of other data points from some of the regional Federal Reserves that shows manufacturing is in real trouble in the U.S. For example, look at the Philadelphia Fed Manufacturing Index. Now, the Philly Fed, anything below 0 is considered contraction. Philadelphia Fed Index rose to negative 8.9 in January from a revised reading of negative 13.7 in December, so less of a contraction, but still a contraction. It was the 5th consecutive negative reading and the 7th negative reading in the past 8 months. So you can see here the Philly Fed Manufacturing Index looks even worse than the national average, in negative territory for pretty much all of 2022. Check out the Empire State Manufacturing Index. Now, this is put out by the Federal Reserve Bank of New York. The New York Empire State Manufacturing Index sank to negative 32.9. Anything below 0 is contraction in January of 2023. The lowest reading since May of 2020. That was kind of a bad month, you might recall. And this is the 5th worst contraction in business activity in New York State ever. New orders minus 31.1 and shipments minus 22.4, declined substantially. And again, you get about the same picture here. Decline in activity for the lion's share of 2022. And when you max out this chart, you can see if we take away May of 2020, this is the worst reading ever, even worse than the global financial crisis shown here around 2009 timeframe. We get the same thing with the Richmond Fed Manufacturing Index. The index in Richmond decreased to negative 11 in January from 1 in December, the lowest since May of 2020. There's that number again. Each of its 3 component indexes were down. Shipments minus 3, new orders minus 24, and employment minus 3. And this was an important data point here. The index for order backlogs retreated further into negative territory, indicating that businesses continued to see declining backlogs. Now, declining backlogs is important because remember the supply chain problems of 2021 and 2022, those have now worked their way through the system. We're starting to see these backlogs of orders slow down. And so a lot of these purchasing managers, they're reducing their future orders because they see the new orders aren't coming in. Well, what happens if that backlog reaches 0? Now you have nothing for your factory to make. And that's when the layoffs start piling up. Again, the Richmond Fed Manufacturing Index was in negative territory for most of 2022. All right, so that was a lot of charts and a lot of data and a lot of indexes. Long story short here, crude oil inventories are rising, even though the artificial supply of oil, the Strategic Petroleum Reserve, has gone away. Less supply hitting the market, and yet inventory is building. We shouldn't have that unless there is a significant decline in oil demand. And that tweet from Giovanni Stanovo points out that a lot of the decline in oil demand is coming from the manufacture of plastics, which is a pretty good barometer for the lousy health of the economy. And we can go look at all those manufacturing numbers and see, yeah, we're not making stuff anymore. The orders are slowing down. The backlogs are reducing. Manufacturing is in big trouble in the United States, and it's showing in the oil markets. Now, it's important to consider both sides of any trade here, folks. I also want to remind you that we've got the reopening in China is just starting to hit the tape, and we have not yet seen what that's going to do to global oil demand. It's entirely possible that the Chinese reopening totally offsets this decline in U.S. demand, and oil prices could conceivably move higher here. And as an indicator of just how severe of a recession we're looking at, the picture in oil markets right now is pretty grim. We've had a warm winter, so we're using less fuel to keep warm. We're seeing a big slowdown in factory activity, and that's resulting in less orders for propylene, which means less crude oil demand to make plastic. And I just want to remind you guys that that analysis was only based on the first 3 data points of 2023, so these numbers could change next week. But the fact is, 3 consecutive weeks of inventory builds right after we end the dumping of the Strategic Petroleum Reserve is a really bad indicator for the U.S. economy. Till next time, live small and dream big.